Tuesday, April 12th, 2022, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at the bond markets, gold and silver. Of course, this is just my opinion, not financial advice. It looks to me, though, that bond yields across the world are rising very sharply, and central bankers are losing control of the narrative, the inflation narrative, and the interest rate narrative. Gold and silver, on the other hand, are doing very well. Commodities have slowed down generally, especially oil, but I think the trend is still higher for hard assets. Gold and silver, of course, have a lot of catching up to do, and I think they will. So that's what we're going to look at. Yes, it's like looking at the markets, but what we'll do, we'll look at the technical picture. We'll look at some year-to-date numbers so you can have an idea of the bigger picture. Of course, I continue to favor hard assets over paper assets, over tech. Tech, of course, has been the main driver of the stock market bubble, and the Nasdaq is a great indicator to look at. We're going to look at the Nasdaq chart and silver chart this morning. Before I start, though, just like to say I visited Gold Investments yesterday in the city of London. I spoke to Oliver and Simon, had a nice chat with them. And Oliver said something interesting about silver. Yes, the premiums are very high in the US and here in the UK. I think in the US, we're seeing premiums at around 18%. In the UK, they're even a little higher for silver. It's about 25%. But Oliver said something very interesting. He says most of his clients, of people buying silver, see it as a penny stock, so to speak. They see it as highly undervalued, and they're not too concerned about the premium. And I said to him that I thought the premium reflected actually the actual price for physical silver, that the paper price that we see is not really a true reflection of the real silver price. Yes, it is frustrating to see the manipulation that is still ongoing. But I think the older I get, the more I think about things. I think things happen for a reason. And I actually think it's a gift that they manipulate gold and silver, especially for people like us who know what's going on, who are able still to stack. And as a bigger picture thing, I think the move from paper assets to hard assets is going to reflect the unraveling of the manipulation, and it's going to, wow, it's going to be a true wonder, I think, to see what hard assets, gold and silver especially, do versus paper assets. And that's why I still believe Dow to gold ratio at 1-to-1. At what level? I don't know. And the other thing I would say before we look at some of the charts in terms of the currency collapse, the hyperinflation. I've always thought that there was a big possibility of hyperinflation. And why is that? Well, because I thought the central bankers and their policy of QE, their manipulation of interest rates down to zero or even negative, governments with their heavy-handed fiscal spending was going to lead eventually to hyperinflation. And what I think we might see as well with the unraveling of the stock market, bond markets, we could see central banks return and try to save the day one more time with even a bigger amount of QE. It's going to make 2020, March 2020, and the QE that resulted from that look really small, I think. And yes, I still expect general commodities to do well, but I expect gold and silver to do even better. The hyperinflation is going to be measured, maybe not in a million percent CPI rate, but it will be measured in the value of the fiat currencies in terms of gold and silver, and that value is going to drop massively. So for $1, you're going to be able to get almost no gold or silver. And I think even general commodities, you're going to be able to get a lot more general commodities with gold and silver. Gold and silver will be the main measure of that hyperinflation. And that's what I see coming. Is it going to happen next week, next month? I don't know. But I think we are on the way there. So I noticed that, for example, in terms of the bond market, I said bond yields are rising and central banks seem to be losing control, and I think they are. For example, the 10-year gilt yield is approaching 2%. Just to give you an idea, in the beginning of 2022, we were still under 1%. We were around 90 basis points, and now we're at 187. And this is the highest level since January 2016. So over 6 years. So it's a 6-year high for the 10-year gilt yield. What's that going to do to the economy? Well, the first thing is going to make it a lot more expensive for the UK government to finance itself. Because what you need to understand, yes, they have issued bonds at lower rates in the past, but a lot of the bonds come home due. And how do they pay off the money that they owe on the principal? They issue more bonds. And the higher yields go, the more they'll have to pay in the primary market to issue new bonds. And that's going to make it even worse. The UK government, like the US government, has huge debt pile accumulated through the years, especially after 2020 as well. I think UK government borrowed like over 20% of GDP. Our national debt has gone through the roof as well. So the second thing, mortgage rates, mortgage yields are set. Are set by the supposed risk-free rate of return that gilts offer. So you will see mortgage yields go up. Mortgage deals in the UK are usually fixed for 2, sometimes 5 years. So a lot of people who might have some mortgage deals mature, they'll have to fix again that rate, and they're going to get a shock because rates are going to be a lot higher. So it's going to hurt the whole economy. So yeah, not good. And I noticed, for example, Aussie 10-year yield, up until recently, the Reserve Bank of Australia was actually, they were doing yield curve control on the 3-year, I think around 25 basis points. And now, for example, we have the Aussie 10-year yield going above 3%. Japan is another story, of course. The Japanese central bank, the BOJ, is actually still maintaining a policy of yield curve control. They announced that a couple of weeks ago because 10-year yield in Japan, the JGB yield, went above, challenged 0.25%. So they came out and said, we're not going to let it go above that level. And as I look here in the last few days, it's right around there. It's around 0.24. I noticed that the yen is dropping a lot further, going through that 125 level. And it seems like they're succeeding in keeping their bond market under control. And I would say that's actually helping Western bond markets. Even though Western bond markets are in kind of a meltdown mode, it would be even worse if the Japanese weren't doing what they're doing, continuing their QE. So I think it's really important that we keep an eye. If the Bank of Japan loses control and that 10-year yield goes above 0.25, it's a little bit like what happened to the Swiss franc and the euro some years ago. The Swiss National Bank put a peg on those two currencies, the Swiss versus the euro. And people never thought that they would let that go. And one day it just, the Swiss franc just went through the roof and the euro collapsed. And I have a feeling that that could happen to the JGB. And when that happens, look out. So yeah, and the US bond market as well, the 10-year yield is approaching 3%. We started the year, of course, at 1.5%. And some people think it might be a little bit overdone, and that might be so. We could see a short-term bounce in bond prices and a drop in yields, but the trend doesn't look good. The 10-year yield, this morning we're up at 284. That's been the high overnight, up another 4 basis points. And the key level there, of course, that will really point to things getting even worse is around 3.25%. That was the high back the last time they tried to unwind everything in 2018. And the same thing holds true for the United States. Like I said about the UK, it will cost the government more to refinance. It will cost consumers to refinance as well. Yes, it's not a good cocktail in terms of the economy. And I'll just show you now a chart of the 10-year yield or 10-year note future. And this is going back to the early 80s, and you can see how we're breaking this trend that has been a 40-year trend, almost upward trend in price, of course. And some people think it could rebound in the near term, but it looks like we've definitely broken. The market is broken, the bond market, and central banks have lost control. So now let's quickly look at what I think are important charts. The first one is the Nasdaq. The Nasdaq has been it's been the star of this last everything bubble kind that we've had since March 2020. And as you can see here, this is a daily chart, but the weekly chart looks just as kind of negative, I would say. It looks like we're building a massive head and shoulder here. And yes, there has been a relief rally from the low that we touched in the middle of March, just below 13,000. But it looks like that rally, counter trend rally, in my opinion, is over. And we're quickly going back down. So that's the Nasdaq. And now I wanted to show you silver, because I think silver is just like the Nasdaq was the champion of this everything bubble. Silver has been the most hated asset of the everything bubble. And I think it will shine, of course. And that's why I've continued to stack silver. And I've also added on to my silver miners position one company that I think could do well. They're a junior exploration, and I spoke to the CEO a few weeks ago, El Oro Resources. This is not like a advice to buy. I have some, and they have a really great project in Bolivia where they could be onto a huge tin and silver find in Bolivia. So that could be a company to look into. But the best way, I think, to find silver companies or silver miners is to look into the Silver Miners Junior ETF and see their holdings. GDXJ, there's plenty of silver miners there too. Have a look in there. and do your own homework. But as I said, daily chart of silver here. And of course, we've had this big consolidation since silver went from below 12 to almost 30 in 2020. And now we seem to be breaking out of this pennant or flag, whatever you're going to call it, or triangle. And in the beginning of March, we made a big move higher towards almost 27, and we've been correcting. But as you can see here, it looks like we're breaking out of this falling wedge, and I think this looks really bullish. This is only a daily chart, so it's a short-term chart. In the longer term as well, though, I'm very bullish silver. And just looking here at GLD, for example, year-to-date GLD, and I don't recommend. I'm looking at GLD because it's easier, because you get the year-to-date. It's kind of a proxy for real gold, but it's not. But year-to-date, we are up 8.3%, 8.34%. SOV now is up 9.3%. And that's, I think, significant, because in the beginning of the year, silver was underperforming gold. And now silver is starting to catch up. And we want to see silver outperforming gold. That will really point to a strong bull market in the precious metals. So there you go. With that, let's quickly look at where the markets are this morning, the market rundown. So it's 8:20 a.m. London time. We've got spot gold at 1957. It's up $3.50. High's been 1960, low 1950. So again, yesterday I think we had a $10 range overnight. So far we've had the same. I think the high yesterday was around 1970, and the usual suspects, of course, came in and sold gold and silver off. But as I said, everything happens for a reason, and patience, I would say. Silver is up 10 cents, around 25.17. The high's been 25.28, and the low's been just below 25. The Dow future is down 157 points, or just under 0.5%. Nasdaq is down about 0.4%, or 52 points. Nasdaq year on year, now it's down about 14.25%. The Dow is down about 5.5%, and the S&P is down about 7.5% year to date. Just to give you an idea, comparison to gold and silver. And also the other thing I would say, those people who have been saying that higher yields and higher interest rates are going to hurt gold and commodities, I think they've been proven wrong for now, and I think they will continue to be proven wrong. S&P 500 is down 0.5%, or 23 points. The FTSE is down almost 0.7% at 75.50. US Stocks 50 is down 1.75% at 37.70. To the currencies now, British pound is down about 0.2%, just above 130. The euro is down about 0.25 at 108.59. A dollar is up 0.1% versus the yen at 125.50. Dollar's down slightly versus the yuan at 637.62. Dollar's up 0.25% versus the Swiss franc, 93.33. Aussie dollar is up slightly at 74.23. The dollar is up about 0.2% versus the Canadian dollar at 126.50. And the Kiwi dollar is unchanged at 68.24. To the general commodities, we've got WTI crude up almost 3% at 96.78. Brent crude is back above 100 at 101.09. And high-grade copper is up 0.5% at 467. Natural gas, U.S. nat gas continues to rise strongly. It's up almost 2% at 683. I won't go over the bond markets because I did already earlier in the video. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.